Quick note, this video is sponsored by Webull. Get yourself 2 free stocks with Webull by depositing $100 with Webull. Link down below. Go to metkevin.com/Webull. It is that stock trading app that I show every day on my live streams. Again, deposit $100 and you will get 2 free stocks worth up to $1,850. Hey everyone, me Kevin here. This morning, Jamie Dimon, the CEO of JP Morgan and Chase, put out a 66-page letter about his opinions on what the heck is going on in the world. And these presumably are also the opinions of JP Morgan and Chase, not just Jamie Dimon. But I want to start with our favorite topic: inflation, market issues, the Fed. So let's jump right into that section of the letter, and then I want to talk about some specific stocks that are really benefiting and taking off today because of this letter. Hint, hint, it's not JP Morgan Chase. So take a look at this. So first of all, he touches on quantitative easing here and basically says, look, we really haven't seen the quantitative easing like what we've had in the last 12 years ever before. We haven't really done this before. And he complains a bit about how there's a lot of regulation on banks that's potentially making more quantitative easing necessary because banks are now required to keep a portion of their money of cash deposits on hand rather than being able to lend that out. And throughout the letter, in multiple different areas, whether that's individual banking or the discount window at the Fed, he's essentially saying, look, because we have to keep more money around, we can't lend when people need it. Stop requiring banks to keep so much money around. He calls this a $3 trillion amount of lost lending that helps us stagnate in our economy. He's very much slamming the regulations imposed on banks. And when this is a section here where he says QE was never effectively tried before prior to the Great Recession. But here's an interesting argument he makes. So he says, quantitative easing reduces interest rates and increases asset prices and creates some spending. So here he's essentially saying, look, when the Fed is printing money, all you're really doing is creating the effect of lowering interest rates, making asset prices more expensive because when interest rates are lower on bonds, more people invest in stocks, and then and people can borrow more to invest in stocks or real estate, and you increase asset prices. Some of that, he says, translates to people spending more money because they're richer, they're wealthier. But he says most of what QE does, most of the money printing that happens with quantitative easing, this is like bond selling and buying, that has mostly an inflationary effect on asset prices. And so this is really important because when we're worried about inflation, we really want to think about asset price inflation separately from consumer price inflation. So just a quick little detail there on how that would work. Fed prints $1, or you know what, let's say the Fed prints $120 billion. Let's go with that example. Fed prints $120 billion. They use that $120 billion they created out of thin air to buy $120 billion from, let's say, JP Morgan and Chase. They don't, but let's just say it's from JP Morgan. JP Morgan now has $120 billion in cash. They have to keep some of that as reserves because of regulations. And then JP Morgan has this choice. Do we make more loans or just buy more bonds? And lately, it kind of seems like a lot of the money gets stuck in the system where JP Morgan just goes and buys more bonds. So really, it's taking printed money and just increasing the demand for bonds, increasing their price and lowering rates. This is how rates stay low, but little of this money actually finds its way into the economy through quantitative easing. It just makes the rich richer, basically. Now, he's going to contrast to stimulus in just a moment, but take a look at some of the downsides he talks about regarding quantitative easing, and I've never considered some of these before. Some of these I have, but some of these other ones were very unique. Take a listen to this. On the other hand, quantitative easing may have some deflationary effects. This makes sense. Lower interest rates is deflationary, and he says that's because businesses have lower input costs. But you also, with lower yields, lower interest rates, provide less income to savers. We've heard that before. But then he says, this could actually reduce consumption. So money printing and quantitative easing, which we should separate that, quantitative easing is one type. Quantitative easing could reduce people's spending because they're making less money on their savings. You're not getting that 2% yield anymore on your savings account like you used to be able to get everywhere, or that 3 or 4% yield that you got in previous days. That doesn't exist anymore. And this means people need to set aside or save more money to protect their retirement income, as he says here. And ultimately, people potentially spend less money, even though rates go down, and we'd think quantitative easing would lead people to spend more money. This is interesting. Something I haven't considered before is especially this retirement savings going up and people not spending in a low interest rate environment because they're just not making as much money as they used to on their savings. Then when he talks about spending for specifically like stimulus measures, he mentions that, look, in recessionary environments with low inflation, you basically should print money and spend it via stimulus. And he says that you can do this without causing overheating or excessive inflation. In fact, he says one of the downsides, or one of the reasons we had slower growth over the last 10 years is because we didn't do enough stimulus. We just didn't do enough in those first 2 years of the Obama era to do more stimulus. Congress was too gridlocked for too long. And what he mentions as well is, look, when we spend money, he talks, and this is where he gets into inflation, which is a fascinating argument that he makes here. Then he touches some more on inflation, and this is an interesting note. He says that after or during World War II, he mentions that this period of high government debt did not create lasting, and that's the key word here, lasting inflation, as the circumstances were different then. We're coming out of a deep depression and money was spent financing a war. Circumstances and starting points matter, he says. And this is where he makes a difference between what happened during the recession and what's happening now. During the recession, he says, the entire financial system was deemed over-leveraged, and that consumers, individuals like you and me, were over-leveraged as well. For years after the Great Recession, there was a massive deleveraging in the United States by consumers and financial institutions. He says today, this is not the case. Instead, the consumer's leverage is lower than it has been in 40 years. On top of that, before the stimulus package of $1.9 trillion, consumers had excess savings of $2 trillion, he says, something that's different than the prior recession right before the global financial crisis. Corporations also have an extraordinary amount of cash, he mentions. And so this is where he comes to a very positive conclusion, but it gets dark right after this. So let's hit the positive conclusion. First, he says, I have little doubt that with excess savings, new stimulus savings, huge deficit spending, more QE, a potential infrastructure bill, a successful vaccine, and euphoria around the end of the pandemic, the US economy will likely boom. This boom could easily run into 2023 because all the spending could extend well into 2023. Something he mentions throughout this report is he does talk about how, hey, look, all of this spending that we're doing on stimulus is not going to be immediate. We're going to keep benefiting from this for years after we spend the money. And so that's an important takeaway from this as well. Now we get to some of the negative from Jamie Dimon. So Jamie Dimon starts off by saying, while equity valuation stocks are quite high by almost all measures, historically, a multi-year booming economy could justify the current price of stocks. So he's being pretty clear here. Stocks aren't cheap right now, but maybe if we have a multi-year bull run in the markets or just the economy, then these prices are going to be justified. Now, he does also say, except against interest rates. This right here is a very Cathie Wood argument that, look, markets have not priced in the fact that we are going to have lower interest rates for the long term, even after temporary inflation, even after the Fed increases the Fed funds rate, which is currently at 0%, even if that goes back to 1.5%, 2%, we are still pricing in interest rates around 5 to 6 to 7% on the S&P 500, when in reality, we should be pricing in interest rates closer to 2 to 3%, which leaves a lot more room for growth stocks going forward. It's a very Cathie Woodian argument. Many people obviously do not agree with Cathie Wood. Now, clearly, Jamie Dimon goes on to say, clearly there is some froth and speculation in parts of the market. He refers to a line from Casablanca. I'm shocked to find that gambling is going on in here, which is obviously sarcasm, at least in this context. Then he goes on to say that the price of US bonds is actually very high right now. Like the 10-year, the price of the 10-year bond is still too high is what he's saying. He thinks it should fall more. And that's because he thinks, look, we've got to be real. There's going to be a lot more debt coming out. So the price of bonds should be lower, which would mean yields or rates go up. And then he says, there's also the not unreasonable possibility that an increase in inflation will not just be temporary. And so he's basically saying here, look, we're gonna have a huge supply of more bonds. So prices for bonds should go down, driving yields up. We need to consider the fact that inflation could happen. That should push prices for bonds down more today because people don't want today's bonds, which should price up yields. So these are two very important things that he mentions here. All right, so then we're gonna run over here and we're gonna see, again, he reiterates that the Fed may be forced to raise rates sooner than people expect. And this is also an interesting segment here, which we've talked about briefly before, but he mentions here much of the stimulus may very well hit when the economy is doing quite well. This is a way of saying, look, the stimulus takes time to be spent. So what happens if all the stimulus we just spent actually starts kicking into high gear in like 2022 or 23 when the economy is actually doing better because hopefully COVID's under control and gone then? And then guess what happens? Inflation, because now it's literally like, imagine this. It's like, oh, the market's down now. Let's pump money into the market and stimulate the economy, right? But what if that takes 2 years to get fully realized? That means a portion, let's call it 25%, doesn't hit until 2023. Well, let's now fast forward to 23. No COVID, everything's booming. Here's another 25% stimulus. It's not a new package. It's just the delay in how long it took for that money to actually go through the system. And then all of a sudden hits and it's like, wait a minute, this is a lot of extra, stimulus. Kind of interesting. So then we go on. Let's see. The government did the right thing by moving extraordinarily quickly to stop COVID-19, blah, blah, blah. Okay. So let's get to some other conclusions here. So I highlighted the best parts. Let's get over here. So over here, he spends a lot of time in his piece complaining about regulation. He says, look, banks should be allowed to fail. There should be no such thing as too big to fail. He also says the problem is there's too much regulation right now. The banks are capitalized. Markets are good. If there's a collapse of a bank, markets will be okay, he says. He's actually very confident in the market, but he's very upset by what he deems as unfair regulation. He compares fintechs to having lower capital requirements, less operational risk, no liquidity requirements, no FDIC insurance, less costly regulation, no social requirements, higher debit card income, and so on and so forth, whereas banks have basically lower or more stringent issues on all these fronts. And basically, he spends a few pages in here talking about how non-banks, neobanks and non-banks are gaining shares in consumer accounts that are creating these effective savings account, kind of like, or things that are like effectively like savings account, like Robinhood savings account. And he makes this analogy here, or actually gives us a stat here and says, look, you take a banking customer with $20,000 or who spends $20,000 on a debit card annually, JP Morgan might only make $120 off that customer, whereas other banks, like the non-banks, are making $240 because of the differences in regulation. And he really complains quite a bit about regulation. I mean, look at this. Onerous reporting requirements, higher litigation expenses for public companies, annual shareholder meetings that focus on matters that most shareholders view as frivolous. Really jaded tone, and he has a lot of this jaded tone throughout a lot of this. And he talks about how well-positioned fintech is with social media, or big tech is with data, to basically white label banking relationships and create huge competition for JP Morgan. Now, JP Morgan basically to this says, look, the game's rigged. We're at the losing end of that, but we won't die yet, so don't worry. Okay, that might be a little bit of a harsh conclusion, but I think it's a fair conclusion. Talks a little bit more about how, look at this. He says, the system is broken. Talks about how heavy these requirements are for banks to keep all this extra liquidity around. But wait a minute. if there's so much more, like there's so much more cash requirements on banks, what happens? Well, the Fed has to step in more frequently when there are issues or stresses in the repo market or the treasury market. If you got rid of all of these extra requirements, banks would be able to provide more lending, and essentially he goes on this tangent about complaining over regulations. Which, in fairness, thanks to Dodd-Frank and some other regulation, banks are way more regulated than like the fintechs. We see that time and time again. Like, I cannot get more than 4 mortgages at JP Morgan, but I can get up to 10, in some cases up to 19 at brokers or fintechs. But JP Morgan can't because Dodd-Frank says the big 4 banks, nope, you can't do more than 4 mortgages for Kevin. It's not JP Morgan's fault. It sucks for them. They're just too big. Maybe they should create their own fintech. A division of, or maybe not a division of, just a totally separate company led by Jamie Dimon. I don't know. Go compete. Can't beat him, join him kind of thing. Anyway, then he talks about how he believes that China believes that America is in decline and that America is going to get basically dominated by China. And this is something that Biden is deathly afraid of, and Biden is really trying to fight this. Jamie Dimon here says that China sees an America that is losing ground in technology, infrastructure, and education, a nation torn and crippled by politics, as well as racial and income inequality in a country unable to coordinate government policies. In other words, our government is very slow. Also says, unfortunately, recently there's been a lot of truth to these arguments. So he's reiterating what China's beliefs are about America. He also goes out of his way to mention the horrific murder of George Floyd. This is taking a position on that. You all know that I'm always 100% neutral on this channel, but there are some people on one side that say George Floyd wasn't murdered. He, was following department policies. And then there are a lot of folks on the other side who say, no way, neon way too long, total murder, abuse of power, right? Again, everybody's got their own conclusions here. I'm not even mentioning a side that I would remotely be on. The point is to say that Jamie Dimon, that's the only thing I'm conveying here, Jamie Dimon took his stand. Okay, good. So moving on. Politics is increasingly divisive. The government is increasingly dysfunctional. These are harsh words. The enormous wealth our country is accruing to the very few. That K-shaped recovery. He blames these problems on wealth inequality. He suggests that 30% of Americans earn less than $15 an hour. Says 85% of high schoolers in inner cities do not graduate. Says, wait, hold on, let's see. I'm sorry, I misread that. While the average American high school graduates approximately 85% of its students, many of our inner city schools don't graduate half. That's the correct statistic. Half of their students. Our healthcare system is increasingly costly, now over $11,000 per person, more than twice our global competitors. Now, I'm not sure if he means per year per person, $11,000. I think that's what he means. But the bottom line there is really twice as expensive of a healthcare system than our global competitors. He complains that 70% of today's youth are not eligible for military service due to a lack of proper education or health issues. Complains about a difficult litigation system and regulatory system that is costly and crippling to small business with red tape and bureaucracy. He does not have a lot of good things to say. Like Jamie Dimon, it just sounds like he is so frustrated, kept up by so many things at night, and feels almost powerless to change some of these things. This is, I think, one of the reasons he has this letter, is to potentially try to provide some solutions. But he also goes on to say that, look, if we keep having this anemic growth, kind of like what we saw between 2018 and 2019, we could end up in secular stagnation. This is a way of what I've been talking about on this channel really throughout this entire pandemic, about possibly entering a frugal decade where people are saving much more than they previously have before. And that's bad, because when people save more, you don't get some of the benefits of faster growth, which here he says faster growth would not only have spurred higher incomes, more jobs, and increased opportunities, but would have also created far more consumption and increased demand for investment, eliminating any potential savings glut or secular stagnation. But he says, my view is if you add it all up, this dysfunction of our government could easily have been a 1% drag on our growth rate. And this is something that he's projecting not just from or looking at from the past 10 years, but also going forward. He complains about society a bit too and says, look, when we debate things, we often see things as binary. It's either you're with me or you're against me, and not looking into the nuance of detail, or blaming scapegoats, or unfairly assigning jaded motives to people like, oh, you know, that person's in it for this or whatever. And he also complains that media hype and people's willingness to be weaponized derail thoughtful strategy. So in other words, he's saying media folks oftentimes come to quick conclusions because it makes for good clickbait. Look at this. Most media and individuals barely have time to focus on the issues and often default to overly simplistic, binary, on or off, and incorrect conclusions that neatly fit into false political narratives. This is a massive slam on America. I mean, he even goes on here to say that we're stymied by self-interest, selfishness, and the buildup of bureaucratic plaque and institutional sclerosis. Jeez, man, this is harsh from Jamie Dimon. I mean, he is going off on many different parts of our country. He does provide some examples of ways to solve this. More acknowledgement by Democrats that spending money, is potentially an issue. You can't just spend money like crazy. But Republicans need to realize that, look, it's okay to have a proper safety net for the elderly, our sick, and our poor. And he points to Germany and Switzerland who have impressive work apprentice programs, Singapore with great healthcare programs, Hong Kong with great infrastructure. But just copy those and don't copy what Argentina, Cuba, and Venezuela have done. He does also give suggestions for having this multi-year national Marshall Plan where you solve these things, like having better training, better education systems, goes into talking about creating more opportunities for jobs and improving wages. And he does give a lot of suggestions to his problems. So he doesn't only suggest issues. He doesn't only rag on America. And in fairness, he has very good suggestions, and he gives suggestions into exactly how we can change things. But folks, this shareholder letter, the loudest arguments that come through this, because we know Jamie Dimon's not about to change Congress, the loudest arguments that are coming through this are that we've got massive problems, not only and these are the sort of the big bottom lines I take away from this. Not only do we have big societal problems where we're way too divisive of a country, which is leading to slowness in Congress. He gives this example of how more soldiers died because it took years for Congress to improve on personnel carriers in Iraq and Afghanistan that weren't armored enough to withstand IEDs. And now you've got many, many more people who are dead or injured or maimed because of IEDs. And he really complains about how dysfunctional our government is. And that, look, as a market, sure, maybe if things keep booming over the next few years, we're good, like fine. Maybe these higher valuations in the stock market are fine, but we've got to be real here. Inflation could come. We've got a lot of government debt. We've got an extremely dysfunctional government. We have, in some sense, I'm going a little further here, what he appears to be, if I'm allowed to summarize in this way, calling our society almost dysfunctional. And maybe if he thinks society is dysfunctional, maybe he just thinks that society or Congress is just a representation of society. He's really bagging on a lot of different things here, and certainly complaining about fintech. I mean, he gave fintech a big old boost today. We've got Square. Square as a stock is one of the few that's up. It's up 5.14% at 248 today. JP Morgan is up 1%. In fairness, but definitely gave a big boost to Square when this letter came out. And I imagine other fintechs as well. But pretty scathing letter here. Very interesting perspective on inflation as well. Something to definitely pay attention to and consider that, hey, you know what? We've got to consider the fact that inflation could actually come. We'll see. I personally, what's my takeaway? Well, look, my bottom line takeaway on this is Jamie Dimon's not going to change society. He's not going to change Congress. He's not going to change the government. There could be a lot of bureaucrats that read this, or congressmen and women who read this, or even watch this video, maybe, who knows, and say, yeah, Jamie Dimon's got a point. Those are all problems. back to normal, back to work. Like, there's little, these changes take decades. The systems that have been established take decades to create, and they'll take decades to dismantle and to improve on. So yeah, there are lots of problems. And the biggest takeaway I had from here is, look, yeah, we might see stagnation through higher savings rates. We might see that frugal decade this year. Maybe we won't see that crazy growth that we're expecting, and maybe inflation will go up. And I think it would be very prudent for us that even if we think the economy is going to boom over this next decade, to at least limit our debt, limit our leverage, and in the event that we get more of these Archegos, these hedge funds blowing up and potentially leading to failures in, the financial system, that we're prepared to withstand that volatility. That our portfolios, we're not going to go bankrupt in our portfolios, and we're not going to sissy hand and paper hand by selling out just because stocks went down a bit. And so we might have to get used to this roller coaster much more than what we got used to in 2020, which was basically stonks only go up. Anyway, hopefully you found this summary helpful from the CEO of JP Morgan Chase. I certainly found it very insightful. I appreciate you watching, and folks, we'll see you in the next video.